If you have been struggling with the complexities of options trading and feel overwhelmed by the jargon, you're in the right place. This video is designed to simplify options trading like never before, making sure that you have all the right foundations in place before even placing your first trade. We will break down all the basics, provide tons of case studies and examples, and most importantly, share our thought process before executing any trade. Hi, my name is Adam Khoo, and I'm a full-time investor and options trader and the founder of Piranha Profits. I've been in the markets for the last 30 years, and I've grown my investment portfolio to a combined value of over $10 million US. Here with me, I've got Piranha Profits' very own options master tactician, who I regard as the best options trader I've ever met, Bang Pham Van.
Hi everyone, my name is Bang. I've been trading the markets for the last 20 years. And I have made $1.5 million US over the past 18 months. For those of you who are new to options, don't worry, since you landed into this video, I think you are in good hands. Adam will brushing up your basic fundamental knowledge of options, while I will bring you through real-life case studies and setups to show you how we trade professionally. Sit tight, grab your coffee, and make sure you take a lot of notes along the way.
When I first learned options over 18 years ago, I can tell you I found it really challenging and very confusing. In fact, it took me over 3 months before I could really understand the concept. But I didn't give up. I kept pushing on, I kept asking questions, I kept reviewing the material. So either I was a very slow learner or my teacher wasn't that good. But once I got it, once I understood how to use options, it was a game changer. It completely transformed the way I invest and the way I trade. And today, I can't live without options because a big part of my profit, a big part of my percentage returns comes from trading options literally almost every single day. Now, don't worry that you're going to take 3 months to learn options or it's going to be really challenging, because it's my goal, together with Bang Pham Van, to create a very easy to understand guide for beginners. So our goal is by the end of this video, you're going to understand what are options, how it works, and how you can use it to increase your returns and generate consistent profits. So why learn options in the first place? Whether you're an investor or trader, options are very powerful because options allow you to make profits under different market conditions. So whether the market is bullish going up, or the market is bearish going down, or the market is going sideways, there are option strategies that you can use to profit from, again, all kind of scenarios, whether it's high volatility or low volatility. Specifically, when used properly, you can actually use options to lower your risk and to lower the capital required in the markets. So with people with lower capital, yes, there are certain option strategies you can use to be able to invest effectively and to trade effectively. For example, last year, 2023, the market was very bullish. The market was going up. And so besides the returns I got from my long-term investments, my options trading generated an additional profit of $681,000. But how about 2022? That was a bear market. Everything was going down, and sure, my long-term investments, the stocks went down in value temporarily, but it didn't matter because my options trading brought in an additional $267,000 in profit in order to buffer the short-term decline in my stock investment portfolio, which later rebounded in 2023. So are you ready to learn options? Let's begin. Now, there are only 2 types of options. Sounds simple? Yep, it is. So first, you've got call options and you've got put options. That's it. Tutorial over. Thank you very much. I'm just kidding. Let's go deeper. Now, if you've ever bought an apartment before in countries like Singapore, I bet you have bought a call option before without realizing it. Let me give you an example. Let's imagine you look for an apartment to buy and you find a beautiful apartment, and then you agree on the price you want to buy it at with the seller's agent. And let's say you agree to buy it at $1 million. So that is called the strike price. So to lock in the purchase price, what you do? You put a deposit of 1% of the purchase price. And 1% of $1 million is $10,000. That's called the premium. So by paying the 1% premium, you are buying an option to purchase the apartment. That option to purchase is called a call option. And that call option gives you the right to buy the apartment at $1 million before the option expires, usually in 3 weeks. And what happens is that the seller of the apartment who collects your 1% deposit, they sell you the call option. So the seller of the apartment is obligated to sell you the apartment at $1 million. So what happens if the apartment goes up in value? Let's say in 3 weeks, the apartment goes up to $1.5 million. Are you happy? Yes, because you have the right to buy it at $1 million. You've locked in the price. If the apartment goes to $2 million, you can still buy it at $1 million. But what if the apartment crashes in value? Let's say within 3 weeks, the apartment from $1 million drops to $500,000. Would you still want to buy the apartment? No. So can you walk away? Yeah, I can walk away. If I walk away, what happens? The most I lose is my 1% deposit. The most I lose is my premium, right? Now, did you know that you can do the exact same thing in the stock market? In the stock market, if you find a stock you like, let's say you say, I like Apple, all right? And you want to lock in the price of Apple before it goes up, you can buy a call option on Apple by paying, that's right, a premium, a deposit. You lock in the price of Apple, so no matter how high Apple goes, you have the right to buy it at that price you've locked in, called the strike price. And if Apple collapses, who cares? I just lose my 1% premium. And the great thing about the stock market is that you can choose call options that expire at different expiration dates. It doesn't have to be 3 weeks like in the property market. You can buy a call option that expires in 1 month, in 3 months, in 1 year, or even in 1 day. So let's take a look at an example right now. Let's imagine that Apple stock is trading at $190 and you want to buy a call option so that you can lock in the purchase price. So which call option can you choose? If you take a look at the option chain from your stock brokerage platform, you can see that there are so many options you can buy at different strike prices. And all these options, they come with different premiums where you have to pay to buy the option. So the first option all the way down there is the Apple 180 June call option. What does that mean? So that means that if you buy this call option, you have the right to buy Apple shares at $180. And to buy this option, it will cost you $11.42. Alternatively, you could buy the Apple 190 June call option, where this call option gives you the right to buy Apple shares at $190. And this option costs less. To buy this option, it costs you $4.15 premium. Or you could buy the Apple 200 June call option, which is even cheaper. This option only costs you 90 cents. And this option here gives you the right to buy Apple shares at $200 anytime before the expiry date. Now, which option do you want to buy? So you can see that if you choose an option with a lower strike price, it's more expensive. If you choose an option with a higher strike price, it is cheaper, which makes sense, right? Because if you choose the Apple 180 call option, that means you have the right to buy Apple shares right now at $180. But Apple's at $190. So if you own this call option, you have an instant profit of $10. And of course, there's no free lunch. That's why this option costs more. It costs you $11.42 to buy this option because it already has an inbuilt $10 profit, which we call the intrinsic value. On the other hand, the Apple 200 June call option only costs 90 cents. Why? Because this gives you the right to buy Apple shares at $200. But Apple's not even at 200. Apple's only at 190. So Apple's stock has to go above 200 for this option to become valuable. And so it's worth less, you only pay 90 cents. All right, so again, Apple stock is now trading at $190. And let's say you decided to buy the Apple 190 June call option. So by buying this call option, what's the premium you have to pay? You have to pay $4.15. So by paying $4.15, you now have the right to buy Apple shares at $190 anytime before the expiry date, which is in June, the third Friday of the month, which happens in 26 days. Now, after you buy this call option, let's imagine that Apple stock goes up. It goes up to $200. Now, are you happy? Yes, you're happy. Why are you happy? Because you have the right to buy Apple at $190, but Apple's now at $200. So theoretically, you could exercise your option and buy Apple shares at $190 and sell it immediately at $200, making you a profit of $10, right? Yeah, so in other words, now your call option is worth at least $10. We call that the intrinsic value of the call option. Now, in reality, your call option is worth more than $10 because there's also what we call the time value left, the extrinsic value, but it's worth at least $10. Now, you bought the option at $4.15, and now the options are worth at least $10. So you could sell your options at $10, making you a profit of what? Making you a profit of $5.85. Now, in reality, I can tell you that most option traders, they do not actually exercise the options. I repeat, most option traders, they don't actually want to exercise the options. Because if they exercise the options, they have to come up with the cash to actually buy the 100 shares of stock, which they don't want to because it's a lot of money. All they want to do is to buy the call option at a certain price and resell the call option at a higher price. And they make the profit difference from the call options itself. So in this case, again, you buy the call option at $4.15, you sell it at $10, you make $5.85 profit. Now, what if after you buy this call option, Apple drops below $190? Let's say it drops to $189. Are you happy? Nope, you're not too happy, right? Because now you have the right to buy Apple shares at $190, but Apple's below $190. So now your call option is not very useful, it's not very valuable, right? And so as time passes, this call option will start to lose value. It loses value, and by the date of expiration, this call option will be worthless. It will go to zero. So what's the worst that can happen? The worst that can happen is you lose $4.15, which is your premium. So when you buy a call option, the worst that can happen is you lose your entire premium. So now let me ask you this question. What if you buy this call option over here and Apple goes to $250? Are you happy? Yes, you're very happy, right? So can you tell me now, what are your options worth? I'll give you a minute, think about it. Apple stock has gone up to $250. Your call options, are they worth more or less? The answer is they're worth more, right? So how much are they worth? Take a minute and make a guess. Okay, so here's the answer. Now, Apple's at $250, but the call option gives you the right to buy Apple shares at $190. So again, you could exercise the option, buy Apple shares at $190, and sell it in the market for $250, making you a profit of $60, right? So in other words, now your call option is worth at least $60. So by buying it at $4.15 and selling it at $60, you make a profit of $55.85. So in summary, the higher the stock price goes, the more your call options are worth. And as the stock price goes down, your call options are worth less. If the stock price goes below the strike price of your call option and stays there by the expiration date, your call options will eventually become worthless. So this is what an actual option chain looks like from the stockbroker's platform. And the one I'm looking at right now is from Think or Swim by Charles Schwab. But whatever options broker you're using, Interactive Brokers or Robinhood or whatever broker, it looks something like that, where you can see, first of all, the different dates to expiration that you can choose. You could choose options that expire in 26 days, which expires on the 14th of June. You can choose options that expire in 5 days, which is the 24th of May. And within that expiration date, you can look at all the different options with the different strike prices. You could choose the strike price of 165, 170, 180, and 210. And again, notice that the higher the strike price that you choose, the cheaper is the premium you pay for the options. Now, in the market, you can either play the role of the call option buyer or the call option seller. And there are pros and cons to both. Let me explain. So if you buy a call option, you pay the premium for the call option. Now, when you pay the premium, who collects the premium? The call seller collects the premium. Now, the call seller is also called the call writer. Now, people always ask me this question: must I first buy a call option before I can sell a call option? The answer is no, you don't have to. You can just go into the market and sell a call option without first buying it, because you're basically writing a contract, which is a call option. So we call it the call writer as well. So for the buyer of the call, by paying a premium, you now have the right to buy 100 shares of the stock at the agreed upon strike price, again, anytime before the expiration date. So for the call buyer, you want the stock price to go up, because the more the stock price goes up, the more the call options are worth. Now, let's take a look at the call seller. Why does the call seller want to sell a call option? Because by selling a call option, they collect the premium. They get money. But of course, by collecting the premium, they are obligated to sell 100 shares of that same stock at the agreed upon strike price. Again, back to the analogy of the apartment seller. When the apartment seller collects your 1% deposit to buy the apartment, they are obligated to sell you the apartment for $1 million. So wherever the apartment price goes, they have to sell you the apartment for $1 million. For the call seller, they are hoping that after they sell you the call option, the stock price will either go down or stay sideways. Because if the stock price stays where it is or goes down, what happens to the call option? It gets worth less and less and less and less until eventually it becomes worthless. When it becomes worthless, the call seller goes, yes, it is worthless. I'm no longer obligated to sell you my shares. But they keep the premium. So a common question that I get is, Adam, is it better to be a call buyer or call seller? And again, there are advantages and disadvantages of both roles. Now, remember, there are three things that can happen to a stock price. Stock price can either go up, it can go sideways, or it can go down. When you buy a call option, you only make money if the stock price goes up significantly and fast enough. You lose money if the stock price goes sideways or if it goes down. So in other words, as a call buyer, you only make money in one of three scenarios. On the other hand, as the call seller, you make money if the stock price goes sideways or goes down. But you lose money if the price goes up too much or too fast. So for the call seller, they make money in 2 out of 3 scenarios. So which party has a higher probability of making money? The answer is the call seller. The call seller has a higher probability of winning. The call buyer has a lower probability of winning. However, for the call buyer, they only risk the premium. The worst that can happen is they lose the premium, but their profits are unlimited. If the stock price goes to the moon, they can make unlimited returns. If the stock price collapses, they only lose the premium. For the call seller, they collect a fixed profit. They collect a fixed premium. If the stock price goes up too much, they could be exposed to unlimited loss. So does this mean that selling call options are risky? You have got unlimited loss? Yes, if you do it naked by itself, which is something that you should never, ever, ever do. In our options mentorship, we teach people to sell call options in a very safe way by hedging with the stock or with other calls. So which is better, a call buyer or call seller? The answer is you can make money in both ways, but they both entail different strategies under different conditions. So let's compare buying a call option versus buying the underlying stock when you are bullish on a stock price. So let's imagine that right now, Apple is selling at $190 and you are bullish. You think that Apple stock will go up to $210. So the first thing that you could do is to just buy the underlying shares. If you buy 100 shares of Apple at $190, what's your capital outlay? Your capital outlay will be 190 times 100, that will be $19,000. So let's say Apple goes up to $210. Now, the market price of your shares will be $210 times 100 shares, that will be $21,000. So what's your profit? Well, if you sell Apple at $210, your profits will be $2,000. So you made $2,000 out of $19,000 of initial capital. So your return on investment, or ROI, is 10.5%. Now let's take a look at what would happen if you bought call options instead. Now recall, one contract of call options is always 100 shares. So to control the same 100 shares of Apple, you buy one contract of call options. In this case, the Apple 190 call options are selling at $4.15. So minimum, one contract is 100 shares. So what is the capital outlay? $4.15 times 100, your capital outlay is $415. So on the onset, you can see that buying a call option requires a lot less capital. Now you only require $415 to control the same 100 shares as compared to $19,000 if you were to buy the actual underlying shares. If Apple goes up to $210, what are your options worth now? Remember, this option gives you the right to buy Apple shares at $190. So you could theoretically exercise the options, buy the shares at $190 and sell it in the market at $210, giving you a profit of $20 per share. Times 100 shares, that's $2,000. So now your options are worth at least $2,000. You bought the options for $415. So if you sell it at $2,000, what's your profit? Your profit is $1,585. But what's your return on capital? Your return on capital is $1,585 from $415 of initial capital. So now your return on investment or return on capital is 282%. Wow, that's a lot higher return than buying the underlying stock. And that is why many traders, instead of buying the underlying stock, they like to buy call options because number one, it requires less capital. Number two, it magnifies their return on capital. And that is what we call leverage. Now, before you get very excited and say, I'm going to buy call options to invest in the stock market. No! Remember, there's no free lunch. Every strategy has pros and cons. So now let me tell you all the risks involved. When you buy a call option, remember that the call option has an expiration date. And every day that passes, the option is losing time value. Options are called decaying assets. They lose value every day until the expiration date. And if the stock price is below the strike price, by the expiration date, the call option will become worthless. So when you buy a call option, not only must the stock price go up for you to make money, but the stock price must go up fast enough before it expires. If the stock price goes up too slowly, you could also lose all your money. And if the stock price goes up too little and not enough to cover the cost of the call option, you can also lose money. Whereas when you buy the underlying stock, time is not working against you because there's no expiry date. You can afford to wait for months or years for the stock price to go up. And when you own the stock, it doesn't lose value every day. And so that is why I tell my students, never buy call options when investing in stocks. Never buy call options when investing in stocks, because in investing, you're taking a long-term approach and the stock may take a long time to go up, and by that time, the call options could be all worthless. Only buy call options for short-term trading. That means you expect the price to move up in the short term, then you use call options. And you must be prepared that if the price doesn't go up fast enough or significantly enough, that you could lose your entire premium with the call options. Now, I can tell you that personally, I hardly ever buy call options. If I'm bullish on a stock and I think it's going to go up and I want to use options, I will use what we call a bullish synthetic spread, which allows me to use options in a way where there's no time value decay. How does that work? Well, these are things that we cover in our options mentorship program. Now, when you trade options, it's important to know how to read a profit and loss chart to know what is your potential risk and potential reward. So over here, you can see that on the Y vertical axis, we have got the profit and loss. So anything above 0 is profit, anything below 0 is a loss. On the horizontal x-axis, we have got the stock price. So stock price can go up, stock price can go down. When you buy 100 shares of a stock or buy 50 shares of a stock, whatever it is, you can see your profit and loss chart is one straight line. Because if the stock price goes up $1, you make $1. Stock price goes down $1, you lose $1. So for example, if Apple goes up from 190 to 210, you make $20 profit times 100 shares, that's $2,000 profit. If Apple drops to 170, you lose $20 per share times 100, you lose $2,000. If Apple goes all the way to 0, you lose your entire capital, which is $19,000. Now, of course, that's theoretical. In reality, it's very extremely rare for a great business like Apple to go to 0. Now, when you buy a call option, what does the profit and loss graph look like? It looks something like this. I call it the Nike logo, where now you can see the downside is limited to the premium that you paid. Recall that when you buy a call option, the worst that can happen is you lose the premium. So even if the stock goes to 0, you can only lose the premium that you paid. So in this example, the premium is $4.15 per share. Multiplied by 100 shares per contract, your premium, which is the maximum loss, is $415. So when you buy a call option, you have got limited risk. Now at the same time, if the stock price goes up to infinity and beyond, you can see that your profit is unlimited. From 190 to 210, you make a profit of $1,585. Now also notice that there's what we call a break-even price. So for you to make money by the date of expiration, the stock price has to go up enough to cover the cost of the option. So the break-even price will be the strike price plus the premium, which in this case will be 190 strike price plus the premium of $4.15, giving you a break-even price of 194.15. How about selling a call option? When you sell a call option, your profit and loss is the inverse. So now you have got an inverted Nike sign. When you sell a call option, you collect the premium up front the moment you sell the call option. And that is the maximum profit that you can make. So when you sell a call option, your maximum profit is the premium that you collected, which in this case, again, is $415. So when you sell a call option, your profit is limited. And as long as the stock price stays where it is, or the stock price goes down, you get the maximum profit. But what happens when the stock price goes up? You can see from the chart that as the stock price goes up, you start to lose money, and the losses are unlimited. So I always like to say, when the stock price goes to heaven, you go to hell if you are selling a call option. So when you sell a call option, it is limited profit, unlimited risk. So you may be thinking, then why would anyone want to sell a call option? I get limited profit, unlimited risk. Are you crazy? Are you insane? Yes, if you sell a call option naked by itself, this will happen. And that's why you never sell a call option naked. If you do, one day you'll be naked yourself. Now, do I sell call options? Yes, I do, but I don't sell them naked. I always sell a call option only when I first own the 100 shares of stock. Because if you own 100 shares of stock and you sell a call option, you are completely hedged. We call that a covered call option, which you will learn in the options mentorship program. You can also sell a call option only if you simultaneously buy a call option at a lower strike price. So all these are fancy strategies, but there are ways where you can sell call options in a low risk way so that the upside risk is limited. In fact, when you sell call options, by first owning the shares, there's no upside risk. So no matter how high the stock price goes, there is no risk to your investment. All right, so to summarize, you can either buy a call option or sell a call option. When you buy a call option, the profit and loss looks like a Nike logo. So limited risk, unlimited reward. However, remember, you only make money if the stock price goes up fast enough and significantly enough. If the stock price goes up too slowly or too little, you lose money. If the stock price goes down, you also lose money. Now, for the call seller, the profit and loss chart is the inverse Nike logo. So now you get the maximum profit when the stock price stays where it is or the stock price goes down. And the profit that you get is the premium that you collect, so limited reward. If the stock price goes up, then you start to lose money. Again, if you sell options naked, which is something that you should never do. And so you sell call options when you are neutral bearish. So that means that you either expect the stock market to go sideways or to go down. Next, Bang will go through with you some recent case studies of how you can apply this knowledge.
Thank you, Adam. Now I would like to walk you through two case studies where I would construct a trade to buy call options and sell call options. So here the chart of Johnson & Johnson. As you can see from the technical standpoint, the stock price has retraced to the new low of the year where it has been successfully bounced off many times in the past. So I'm expecting the stock price to rebound as well in the next few days. So there is a very strong support at the horizontal 145 price where I expect the stock price to rebound from here. And that is a good setup for buying a call option, expecting the stock price to go higher to benefit from that. So here's the trade I'm looking at. First of all, on the time frame, I'm choosing January 2026, which is 1.5 years from now, for buying a call option. And call option for Johnson & Johnson is relatively cheap. So even if I go that far, I'm paying like $15.45 for one contract, which is equivalent to buying 100 shares. So that means my max loss in the trade is $1,545. I cannot lose more than that, regardless where the stock price goes. Even if it goes to zero, I won't lose more than $1,545 for the trade. Now, I have 1.5 years to lose that money if the stock price doesn't go up. But if you look at the scenario when the stock price goes up, I have unlimited upside potential. There's no cap on the upside and as to how much I can make in this trade. So I just want to use a very realistic scenario here when the stock price rebound by 18 points, which go back to the previous high, or it could drop 18 points from today. Now, if the stock price goes up by 18 points, which hits like $163 or so, the trade would make about $1,200 for that trade. Well, that translates into what? 80% return on investment, which is pretty good. On the other hand, if the stock price falls $18 to about $127, guess what? I'm not losing $1,500. I'm losing only half of that. And I still have 1.5 years to go. I'm not going to lose all the money until the option expires by January 2026. So as long as I'm still in the trade and the time is still far away, a stock price can rebound and the trade could turn profitable again. So it's a very good trade setup for such a, buying a call option here. I'm not losing a lot of money every day. So one of the reasons why I choose 1.5 years of expiration for the trade is because I don't want my option to decay or to lose value very fast. When you buy a call option, you will have the time decay every single day. But by choosing a long expiry date, the decay is very slow, especially in the first few weeks or few months, right? So just staying on the trade here, if the stock price goes nowhere, I'm not losing much money every single day. That is the reason why I choose that long expiry date for the option. So that's something I would consider. And the reason why I choose the plus or minus $18 per share is based on implied volatility at the moment in time. And you can go to the platform, they will tell you the market expect the stock price to move plus $18 or down $18 within that range over the next 1.5 years. And that is a realistic stock price range that I should expect from this trade. And I will explain that in detail when I talk about option Greeks. Now let's talk about selling call options. I'm looking at another case study here, Skyworks solution. So if you look at the chart right now, the stock price is actually approaching a very strong resistance level at 109. You see there the stock price has failed to break above 109 many times over the past 4 or 5 months. I expect this to be a very strong resistance this time as well. So with that, I would sell a call option at a higher strike price than the 109. So I'm looking at selling a call option at 111, which is additional $2 above the resistance, right? So at least it gives me some margin for error, right? So in case the stock price breaks above 109, and I still have $2 for the buffer for me to take action. So that's the reason why I choose 111. And with that, I collect about $1.9 premium, which is about $190 for the total premium. Now the expiration date for the trade is July 26, 2024, which is about 1 month in this case. So in the next 1 month, if the stock price doesn't break above 109, or even if it breaks above 109 but stay below 111, guess what? I'm still collecting this $190 as a profit. So this is a trade I would consider as well. What if the stock price goes beyond 109? So in that case, I would close the trade, probably for a loss. And you see, if the stock price goes to 110, I probably lose $200, which is about 100% of the total premium I receive. And that is my loss in the trade. So when you trade option like this, you have to be very clear what is your stop loss. So in this case, I would cut loss when the stock price breaks above 109. Or the latest time I need to cut loss is when it hits my strike price, which is $111. Now, I don't do this. This is something people call it selling a naked call, where I can have an unlimited risk potential. As you can see there from the chart, the trade would have unlimited risk if the stock price goes through the roof. Now, in the option mentorship program, beyond the option strategies, we also teach you on how to do technical analysis, like the one I just explained for the case studies here, and how to file your own trade setups. As you can also notice that when I buy a call option, I choose a very long expiry date because I don't want my option value to decay fast. On the other hand, when I sell option, like in this case, I choose a shorter expiry date, which is like within 30 days. As a seller of the option, I want the option value to decay fast, so that when it goes down in value, that's where my profit will be realized. So in this case, you notice that my option will expire in 30 days. If the stock price doesn't go up above the $111, I will generate that $190 profit. Later on, when I talk about option Greeks, I talk about theta. You see in this chart, the number below there, the theta shows the trade has $6.39 per day. That means every single day, the time decay will bring me $6 profit. Now, in the option mentorship program, beyond the option strategies, we also teach you on how to do technical analysis, like the one I just explained for the case studies here, and how to file your own trade setups.
Let's now talk about put options. Now, when you buy a put option, you're buying a contract that gives you the right, not the obligation, but the right to sell 100 shares at the particular agreed upon price. Again, we call that a strike price, anytime before or on an expiration date. Now, if you think about it, a put option is actually an insurance contract. Let me give you an example. Let's imagine you live in a house and your house is worth $1 million. And you can see that there's a fire approaching your house. So what do? You want to buy fire insurance to protect your house, to protect your $1 million home value. So when you buy an insurance contract, you pay a premium. And by paying a premium, what happens? You now have insured your house for $1 million. So if the fire comes and burns your house 50% down, you have no worries because you have the right to still sell your house at $1 million. Even if your house goes to zero, no problem, you still can sell it for $1 million. Now, if the fire doesn't reach your house, you don't have to use your insurance contract because your house is fine. And the only thing that you lose or you pay is your insurance premium. And we do that every year, don't we? Every year we pay our car insurance, we pay our house fire insurance, but we don't hope that we get into a car accident. We don't hope that our house burns down, and we just pay this premium every single year. Now, the same thing happens in the stock market. So there are many people in the stock market where they own shares of Apple, they own shares of Visa, and they have this fear, what if it drops, what if it collapses, it's going to be a market crash. So to protect their shares, they buy put options, which are insurance contracts. So by buying the put option, they pay a premium, and by paying this premium, they have the right to sell their shares at an agreed upon strike price. So let's take a look at an example. Let's imagine that Visa is trading at $280 and you want to buy a put option on Visa. You want to buy insurance on Visa. So if you go to the option chain, you can see that you can choose various options at various strike prices and various date to expiration. And they all have a different cost or premium. So for example, this first option that you see here is called the Visa 290 June put option. And it's selling at a premium of $10.05. So if you buy this put option, you have the right to sell Visa at $290. So even if Visa goes to zero, you can still sell Visa at $290 anytime before the expiration date in June. Usually it expires on a Friday, which in this case expires in 26 days. And again, this premium or this option costs $10.05 premium. You can also choose to buy the Visa 280 June put option. So this put option gives you the right to sell Visa shares at $280. And this option costs less. It costs $3.70. Or you can choose the Visa 270 June put option, which costs even less. This option only costs 96 cents. But this option gives you the right to sell Visa shares at $270. Now, obviously, you can see that the higher the strike price that you choose, the more you want to insure your stock for, the more expensive it costs to insure it. So let's imagine you decide to buy the Visa 280 June put option and you pay a premium of $3.70. After you buy this put option, Visa crashes. Visa goes down to $250. Are you happy? Yes, you're happy. Why? Because you have the right to sell Visa at $280 and Visa is now at $250. So theoretically, you could buy 100 shares of Visa from the stock market at $250, exercise your put option and sell it at $280 to the seller of the put option, making you a profit of $30. So in other words, your put options are now worth at least $30. We call that the intrinsic value of the put option. But in reality, the put options will be worth more than $30 because there's also what we call the time value left or the extrinsic value, but it's worth at least $30. So recall, you bought the put option at $3.70 and now you can sell the put options at $30. So that gives you a net profit of $26.30. In reality, do people actually buy the shares, exercise the put option, and sell it at the strike price? No, they don't. Again, in reality, option traders never exercise their options. All they do is to buy the options at a low price and resell it at a high price. And that's how they make the profit without even having to touch the shares or to exercise the options. Now, what happens if Visa doesn't go down? Visa stays at $280, or it may even go up to $281 and stays there. You're not too happy now because now your put option is not worth much anymore because your put option gives you the right to sell Visa at $280, but now Visa's at $281. So why would you want to use your put option? So in this case, the put option will start to lose value, loses value, and by the date of expiration, if Visa stays at $280 or higher, the put option will become worthless. And what's the most you lose? you lose your entire premium, which in this case is $3.70. So again, when you buy a put option, the worst that can happen is you lose the premium that you paid. Now, what if Visa goes to zero? Are you happy? Yes, that's a put buyer's wet dream. Because if Visa goes to zero, then theoretically you can buy Visa shares at zero and exercise the put option and sell Visa at $280, making you a profit of $280. Wow! So the best scenario is when the stock goes to zero. As a put buyer, you make the maximum profit of $280 minus the premium of $370, making you a net profit of $276.30. So in summary, the more the stock price goes down, the more the put options are worth. The more the stock price goes up, the less the put options are worth. So once again, in the market, you can either play the role of the put buyer or the put seller. When you are the put buyer, you pay the premium. When you pay a premium, who collects the premium? The put seller, right? So again, as a put buyer, you pay the premium and you have the right to sell 100 shares of the underlying stock at the agreed upon strike price. So as a put buyer, you want the stock price to go down. The more the stock price goes down, the more valuable are your put options. Remember, you are buying insurance, so you want the house to burn down so you can collect the insurance money. Now, on the other hand, let's take a look at a put seller. Why does the person want to sell the put? Because they collect a premium. Now, the put seller is like the insurance company. The insurance company sells insurance. They sell car insurance, they sell home fire insurance, and they collect premiums from all the people out there. But by selling insurance and collecting premium, the put seller is obligated to buy the 100 shares of stock at the strike price, anytime before or on the expiration date. So for the put seller, they want the stock price to stay where it is or for the stock price to go up. If the stock price stays there or goes up, the put options will be worth less and less and less and less until by the expiration date, if the stock price is at or above the strike price, the put option will become worthless. And once the put option becomes worthless, the put seller goes, yes, it is worthless. I'm no longer obligated to sell 100 shares. And they just keep the premium. So is it better to be a put buyer or put seller? Again, they both have their pros and cons. Recall once again, the stock price can only do three things. It can either go up, it can go sideways, or it can go down. When you buy a put option, you only make money if the stock price goes down. And it must go down fast enough and significantly enough. Then you make money. If the stock price goes sideways, goes down a bit, goes up, you lose money. So for put buyer, you only make money in one of three scenarios. So the probability of making money is lower. But when you sell a put option, you make money if the stock price goes up and goes sideways and even go down a bit. You could only potentially lose money if the stock price goes down a lot. So in other words, when you sell a put, you make money in 2 out of 3 scenarios. And as a put seller, your probability of making money is a lot higher than a put buyer. Now, on the other hand, when you buy a put option, your risk is limited. The most you can lose is the premium. And if the stock goes to zero, you could make a lot of money. So limited risk, but a lot of reward if the stock price collapses. When you sell a put, the profit is limited to the premium that you collect. And if the stock price goes down a lot, yes, theoretically, you could lose a lot of money if the stock price never recovers. Now, personally for me, almost every day, I love to sell put options because I'm kind of like the insurance company. I'm selling insurance and I'm collecting premium almost every day, but I only do it on very, very safe companies that may drop temporarily, but they always bounce back shortly after that. And as a put seller, I'm obligated to buy 100 shares of the stock if the price stays below the strike price. As long as it's a good company and I'm willing to buy the 100 shares, there is actually not much risk for me selling put options. And this is something that I will teach more of in our options mentorship program. So what's the profit and loss chart when you buy a put option? Well, it looks something like this. So once again, On the y-axis, we've got the profit and loss vertically. On the x-axis, we've got the stock price. And you can see that when a stock price goes down, the profits increase. And the maximum profit is achieved if the stock price goes to zero, which actually is pretty rare. And if the stock price goes up, you start to lose money. But the maximum loss is the premium that you paid. The stock price has to drop enough to cover the cost of the put option at expiration. That's called the break-even price. So the break-even price is the strike price minus the premium that you paid for the put option, which in this case will be $280 minus $370. So your break-even price at expiration is $276.30. The stock price has to drop below that for you to make money on the date of expiration. And if the stock price goes up, you can see the maximum loss will be the premium that you paid, which is $370. And for example, if the stock price drops to $260, you can see that the profit that you make is $1,630. Now, when you sell a put option, this is what the profit and loss graph looks like. So once again, when you sell the put option, you can see that if the stock price stays where it is or the stock price goes up, you get the maximum profit, which is the premium that you received, which in this case is $3.70 times 100, $370. If the stock price goes down, you can see that your put that you sold begins to make losses. Now, this loss is only realized if you buy the put option back at the loss. However, as a put seller, if you simply let the option expire and you are obligated to buy the 100 shares at the strike price, you don't actually lose money. If you have the holding power to hold a good company and the shares increase in value, then there's actually not much downside risk. And this is something that I do myself almost every day in the markets that we'll be covering in detail in the options mentorship program. Now, if the stock price goes down, you can see that you're actually losing money when you sell a put option. This is only true if you sell the put option naked. So once again, never sell put options naked, just like never sell call options naked. So for me, I sell put options almost every day, but I don't sell it naked. I sell put options that are covered. We call it selling cash secured puts. So that means that I already have the cash where I'm able to buy the 100 shares of stock if the stock price stays below the strike price by the expiration date. So by having the cash to actually own the shares and holding the shares till it recovers, I no longer have any downside risk. So these are things that we cover in detail in the options membership program. Now, for some recent case studies, let's go back to Bang.
Thank you, Adam. Now I'm going to show you two recent examples of how to set up a trade to buy a put option and to sell a put option. The first one I'm looking at here is Walmart, right? WMT. As you look at the chart from the technical standpoint, the stock price has been doing very well, right? It has been hitting on time high right now, and it seems to be a little bit overextended. So imagine when something like goes up in a straight line, it tends to pause or even retrace or pull back. So that's what I'm looking at the chart of Walmart here. It is overextended. So then I would like to buy a put option. So if I'm holding a share positions in Walmart and I expect the stock price to pull back, I could buy a put option to protect my stock holding. So I'm looking at Walmart here. I say because the stock price is going to pull back soon, I would buy a put option. So I'm looking at the option of Walmart expiring on 16th of August here, which is about 2 months from now. And the strike price I choose is 65, which is slightly below the current stock price. That means I have my protection at 65. So if the stock price drops below 65 or much lower, I'm not concerned at all because I'm protected at 65. So if the stock price drops below 65, my put option will make money. And that will offset the loss in my share positions. So this is a good way for you to buy a protection or an insurance for your stock. And the good thing about this put option is it is cheap. I paid only $1.02. So for 100 shares, that means $102 for the trade. And I have 2 months. So with $102, I can have a protection for 2 months. It's a very cheap insurance, and I could consider, especially now the stock price has gone up so much so fast. And every day passes, how much I would lose? Well, you look at the theta there, the trade would lose about $1 a day. Not a big deal, right? And I can sleep very well with this put option protection. And the reason why I choose 65, because I want to at least lock my profit at 65. So whatever profit I made until now, I want to lock it in so I cannot lose on the profit I have made until today, which 65 close to the current stock price. So I want to protect as much as possible. And I choose 2-month expiry because 2-month expiry, the option will lose value rather slowly. It's not like 1 month. The 1-month expiry would lose value very fast, but 2 months, the option value will lose a little bit slower. Here's another chart I'm looking at on Hershey, the chocolate making company. It's a fundamentally good stock. In my valuation, this stock is worth $228 per share. And right now it's trading at 183, way undervalued. And from the technical standpoint, the stock price has retraced and bouncing nearby the horizontal support at 181. And you look at the past 6 months or so, every time it hits that level, it rebounded. And I'm expecting a rebound to happen very soon. On top of that, you look at the stochastic full is one of my favorite indicators. The stock is oversold right now. So every time it hits the oversold region, as you can see below 20 level, it will reverse up. That means when the stock price will rebound. So that's I'm looking at from the technical standpoint. So this is just one of the many indicators I'm looking at. So horizontal support and now the stochastic full as well. Now the option that I'm looking at to sell the put on is the 175 put option expiring on July 26, which is about a month from now. As you notice, every time I sell option, I prefer to sell options that expire within 30 days so that the value can decay very fast and I could reap the benefit faster. So in this case, I'm looking to sell a put option at 175 strike price. So what does it mean when I sell a put option at 175? As a put option seller, my obligation is to receive or to buy shares if the stock price drops below 175 on the expiration date, right? So I will be assigned shares at $175 per share, which is a good deal for me because at the current stock price, 183, it's already undervalued. At 175, I could buy the share at even much better discount versus today's price and versus my valuation of the stock, which is a huge discount for me. So I don't mind owning Hershey shares at $175 per share. Now, by the way, by selling a put option at 175 strike price, I would collect $2.50, which is $250 for one contract. That will bring my cost of owning shares to even lower. So 175 minus 2.5, that means my cost of buying shares is only 172.5. So that means I can have a big discount versus the stock valuation. And I don't mind doing it month in and month out, collecting premium. Now, in the case the stock price rebounds and not drop below 175, guess what? I would not get to buy shares, but the $250 that I'm collecting here would be my profit. And that's not a bad deal either, right? Because I'm getting the money for free, basically. So either I would own the shares at the better discount versus the current stock price, or I can get $250 profit and do it again next month. So if I keep this trade until the expiration date, which is on 26th of July, 2024, the trade would have a break-even point at 172.5, right? The vertical line there. That is where the trade would break even. So simply the 175 minus the $2.5 premium I received. That is a break-even point for the trade. Now with that, you notice on the top of the chart, I have 74% chance of winning. So the trade has 74% probability of being profitable. That's the beauty of selling a put option. You have very high probability of winning. The price has to drop below that break-even point for me to lose money. But you can set the probability of winning for your trade by choosing different strike price as well. right? If you choose a lower strike price like 170, your trade would have a much higher probability of winning, but you will receive less premium for the trade. So this is something you can play around when you sell put option. And if you notice also, the stock price has to drop to that break even on the expiration date for you to lose money, which is very unlikely, right? You look at the theta, which is the time decay per day. Every single day, this trade will bring me about $7, $7.25 a day. And that number will accelerate as well. So it's the beauty of selling option. You have time that works in your favor, so you are paid to wait. And in this case also, you have very high probability of winning. And even if the stock price drops so much, guess what? You can own the good stock there at a very high discount level. So it's a win-win situation.
So let's summarize everything. So again, we've got call options and put options. You can either buy a call option or sell a call option. You can either buy a put option or sell a put option. When do you do what? Well, you buy a call option when you are very bullish, because when you buy a call option, you make money when the stock price goes up significantly and fast. When you buy a put option, you buy a put option when you're very bearish, because when you buy a put option, you only make money if the stock price drops significantly and fast enough. If you think that the market is neutral to bullish, like it's going to go sideways or up a bit, then you could sell a put option. If you think the market is neutral, bearish, like the market's going to sideways or go down a bit, you sell a call option. So in summary, these are the 4 things that you can do. So let's understand the meaning of intrinsic value of call options. So again, let's imagine Apple is trading at $190. You go to the option chain and you can see all the different options at different strike prices. If you look at the option with the 180 strike price, what does that mean? Again, if you buy this call option, you have the right to buy Apple shares at 180 and sell it in the market for 190, giving you an immediate profit of $10. So that immediate profit that's inbuilt into the option is called the intrinsic value. So in other words, the intrinsic value of a call option is the stock price minus the strike price. 190 minus 180 is a $10 intrinsic value. And we say that this option is in the money because it has got intrinsic value. Does this mean that you can buy this option for $10? No, you have to pay more than $10 because besides the intrinsic value, the option has some additional value called the extrinsic value. So you can see that the premium is $11.42. If you look at this option with a strike price of 190, again, what does this mean? It means you have the right to buy Apple shares at 190 and sell it in the market for 190. So is there any inbuilt profit? No. So there's no intrinsic value. There's zero intrinsic value. We say that the option is at the money. But is it worth something? Yep, it's still worth something. It's worth $4.15. That $4.15 is what we call hope value or extrinsic value, because there's a hope that before expiration, the stock of Apple could go up above 190 and this option could become valuable in the future. So there's still a hope there. So as long as there's hope, people are willing to pay money for that hope. So that's the extrinsic value. How about the 200 strike price call option? Now, again, if you buy this call option, you have the right to buy Apple shares at 200. But right now, Apple's at 190. Why would you want to buy it at 200, right? So you can see that this option is out of the money. It has no intrinsic value at all. But it's still worth something. It's worth the hope value of 90 cents. And again, this hope value is called extrinsic value. Let's now look at put options. So again, let's imagine right now, Visa is trading at $280. And if you look at the option chain, you can buy the different options at the different strike prices. If you look at the first option, this has a strike price of $290. So if you buy this option, you have the right to sell Visa at $290. So you could buy Visa at $280 in the market, exercise the option and sell it at $290, giving you an instant profit of $10. So there's a $10 profit built in to the option. That's called the intrinsic value of the put option. So for put options, the intrinsic value is the strike price minus the stock price. It's the opposite of the call option, right? So you can see that $290 minus 280 is $10. So can you buy this option for $10? No. You have to pay a bit more for it because there's still some hope that the stock price could move down even more. So the premium you got to pay is $10.05. You pay a 5 cents additional hope value to that. If we look at the 280 strike price option, that means you have the right to sell Visa at 280. But Visa is already at 280, right? So there's no inbuilt profit for this option. So it is at the money. There's no intrinsic value, but the option is still worth something called the hope value, which in this case is $3.70. Finally, let's look at the put option with the strike price of 270. Once again, if you own this option, you have the right to sell Visa at 270. But now Visa is at 280. Why would you want to sell it at 270? So this option doesn't have any intrinsic value. Zero intrinsic value, but it is worth hope. There's a hope that Visa could drop below 270 before the expiration date. So the hope that you pay for the premium is 96 cents. So the price you pay for the option is called the premium. And again, if you sell the option, you collect the premium. So what makes up the premium? The premium is made up of intrinsic value and extrinsic value, as I have mentioned before. The intrinsic value is the part of the option that is in the money. So for a call option, the intrinsic value is the stock price minus the strike price. The higher the stock price goes, the more intrinsic value the call option has. For the put option, the intrinsic value is the strike price minus the stock price. And the lower the stock price goes, the higher the intrinsic value of the put option. The other part of the option premium comes from the extrinsic value, or we call it the hope value. So there are two things that give us hope. Number one is the time left to expiration. We call that the time value. So if you buy an option that expires in 60 days, there's more time left, it's worth more. You buy an option with only 1 day left, there's less hope, it's worth less, right? So we call that the time value. And the time value would decline every day as time passes. And by the expiration date, the time value becomes zero. The other part of the extrinsic value is called the volatility premium. So in other words, when the market is more volatile, when stocks are going up and down faster, the options are worth more. If the volatility is lower, the options are worth less. It's kind of like in hurricane season, you want to buy insurance on the house, it costs more to buy insurance during hurricane season because it's more volatile, right? So just remember that on the date of expiration, the extrinsic value of any option becomes zero. And the value left is the intrinsic value. All right, next, let's go back to Bang, who'll be talking about option Greeks and how to master option Greeks to make better option trading decisions.
Now let me introduce a new concept of options here, the Greeks. This is a rather advanced concept that even me, I was not aware of this in the first 7 years of my option trading journey. And I lost money many times because I did not know this exists. Greeks measure the impact of different factors on option values. So you know the option value will change every single day based on different factors like the underlying stock price, like the volatility, like the time decay, like the interest rate, right? Those are the factors that affect option value every single day. Now let me get into each of those. First of all, delta. Delta measures the option premium change for every single dollar change in the stock price. You know the option is a derivative from the stock. So option is built on stock. If stock price moves, option value will move. What is the difference between the stock price move and the option value moves? Well, that's the delta. Delta measures the impact that every single dollar in the stock price moves, how much is option value will change, right? So that is the delta. So let me use this analogy for your understanding. Look at the stock. It's like the adult person there walking with the kids. Depends on the small kids or grown-up kids. So delta less than 50 means you walk with the small kids there. The option is a kid. So the stock price walk one step, the option need to walk 2 or 3 steps to catch up with the stock. So that's what the low delta is. Low delta option has very little sensitivity to the stock price. Stock price moves $2, then the option can move $1. Or stock price move $3, then the option value will move $1. So that's less sensitivity, right? On the other hand, if the delta is more than 50, the option value will be more sensitive to the stock price. Stock price moves 1, the option value can move like 0.8, 0.9. So it's like you walk with the adult kid. You walk one step, he can almost catch up with you on the same step, right? So that's a different delta for different option trade. And in the option chain, you can select low delta, middle delta, or high delta for your option trade. It's up to you. And in the option mentorship program, we'll teach many strategies that have different delta as the entry rule, right? And we get into the detail on each of those strategies. So when you buy a call option or you long a call option, you are net long delta. Mean the stock price goes up, that will increase your call option value. So it's good for you. On the other hand, if you short a call option, you are short delta. Mean if the stock price goes up, your trade will be hurt. So go back to the example of buying a call option on Johnson & Johnson. So in this case, I'm buying 145 strike, which has a delta of 0.57. Now, what does it mean? It means that if Johnson & Johnson stock price goes up by $1, my option value will go up by 57 cents, right? So if you don't like it, you say, okay, I want my option value to go up more than 57 cents every time the stock price goes up by 1. Guess what? You need to choose a higher delta call option to trade. So in that case, you need to go to a lower strike price for call option, which has a higher delta. So you need to go to like 140 strike price or 135 strike price to have a delta of like 70 or 80. So that means when stock price goes up by 1, your option value will go up by 70 cents or 80 cents. So the delta can be used as a proxy to tell you what is the probability that the option will be expired in the money. So like in the case of Johnson & Johnson, when I choose 57 delta, that means I have 57% chance the option will be expired in the money, meaning the stock price will go higher than my 145 strike. So if you choose the lowest strike for the call, that means you have a higher delta. That means there's a higher chance that the stock price will close in the money for your options, right? So sometimes people use that just to have a gauge of percentage of probability. So another example where you can consider different delta for your buying call option trade. So I'm looking at Palantir here, and Palantir is a relatively new company which is working on AI, and it has a tremendous potential. But because it's a new company, nobody knows how the company will perform in the future. So it's kind of a more speculative trade here. I believe Palantir could be a multi-bagger. So then I'm looking at buying a call option here. Now, I need to consider whether I buy it at a higher strike, like $30, which is out of the money, because today the stock price is at 26. Or I can choose a 20 strike price, which is in the money call option. And you can notice the two trades I'm thinking here. Buying a call option that is out of the money, the 30 call, would be cheaper. I'm paying like $5.10, which is $510 for the trade, one contract. My risk will be lower. I cannot lose more than $510. And I have all the way to January 2026, which is 1.5 years from now. But if I am more bullish on the stock, I think the stock price will go higher, then I go with the lower strike price, which is a 20 strike, which has a higher delta. All right? So in that case, if the stock price goes up, my 20 call option there would have more benefit. The value of the option will go up faster or more compared to the 30 call option. But the trade-off is the 20 strike price call option there will be more expensive. I will need to pay $8.77 or $877 for the trade. So the max loss that I could lose in the trade is higher. So it's a trade-off there. You want a more impactful trade, benefiting more when the stock price goes higher, you go with the higher delta trade, in this case buying a call option. Or if you want to limit your risk, more speculative, you choose a higher call option, higher strike call option, which have a lower delta, then your risk will be lower. And when the stock price goes up, this 30 call will go up less than the other one. right? So you have to consider which one. If you go with the risk, then go with the higher strike. If you are more convinced that the stock price will go higher, then I would go with the lower call strike, the 20 call. The next Greek is gamma. Gamma measures the change in the delta for every dollar change in the stock price. Let's go back to the Johnson & Johnson case. I'm thinking to buy 145 strike, which has 57 delta. Now that 57 delta is for the first dollar's move. If after the stock price move $1, the next $1 move, my option value will not increase by 57 cents anymore. It will increase more than that, maybe 60 cents for the second dollar's move. Now the delta between 60 and 57, that is the gamma. Next one, theta. This is something that I always pay attention to. Theta is time decay. You know option has expiry date, and because of that, the value of the option decays every single day. How do you measure the decay of the option? Well, that is theta. Every single day passing, how much your option value will lose. Now, option value will decay faster when it moves towards the expiry date. That's why in the case of Johnson & Johnson, I choose 1.5 years for the option because it is long expiry. That means the decay is very slow. As a buyer, I don't want my option value to decay fast. That's why I choose a longer DTE or longer expiry date. But as an option seller, in the case of selling Hershey put option or selling Skyworks Solution call option, I choose a shorter expiry date within 30 days. Because the last 30 days of the option before expiry date, that will be the fastest decaying time. The decay accelerates towards the expiration date. I prefer to be a seller of the option because time decay works in my favor. Time decay is my friend. I am paid to wait every single day. Moving on to the next Greek, rho. Rho measures the option premium change for every 1% change in the risk-free interest rate. Now normally, the interest rate don't change every single day, relatively stable over the time. So the impact of rho will be very insignificant. Lastly, volatility. Volatility, that is something quite interesting and that can separate the novice from professional. If you are a new trader, normally you don't pay attention to volatility. But I tell you what, in my early years of trading, many times I bought call options for earnings play. I pick the right direction, stock price goes up, but I see my option value decay and I lost money in the trade. Why is that? Well, after the earnings, the volatility crashed. That means the option value dropped significantly after the volatility has gone. So you need to pay attention to volatility because that could form a big part of your option premium as well. Now, you notice that some stocks tend to move more than the other. Like you look at Tesla, you look at Nvidia, they tend to move a lot more than like Johnson & Johnson or Procter & Gamble. And the higher the volatility of the stock price, the more expensive the option premium will be. Also, volatility tends to go up towards some key event. For example, before Apple launched new iPhone, the option value tends to go up because the volatility increases. Or before the FOMC meeting, stock price tends to be volatile and the option value also goes higher. Also, like pharmaceutical companies, where they're waiting for the FDA make the announcement on their drug trial, the option premium also increases. Now, when you look at volatility, you can consider two factors. One, the historical volatility, the one that has happened already in the past 1 year. And the one is still ahead of you, which is implied volatility. And the relation between the two, we call it implied volatility ranking or percentile. Now, first of all, historical volatility. That measures the volatility in the past 1 year. It's like when you drive a car, you look at the road behind you, the one that you have just passed, and you see the road condition. You say, okay, the road that I just passed, the condition is not bad. It's not bumpy, it's smooth, so everything's good. So that is a historical volatility. On the other hand, if you look at implied volatility, that is the road condition ahead of you, the one you have not passed yet. Okay, you look at the road in front of you there, it looks very bumpy, right? That means the implied volatility is very high, the one that it has not happened yet. But the market indicates that, hey, in the next month or so, the stock price could move a lot. So that is implied volatility. Now, implied volatility is calculated based on different option pricing model, like the Blackstone models. That's just the market views on the volatility of the stock price in the future. So what is implied volatility measure? It measures the potential stock price move range in the next 1 year, right? So for example, if the stock price right now at $50 and the implied volatility say 20%, that means the market expects the stock price to move up by 20% or to move down by 20%, which is $10. So the range of the stock price move that the market expecting is from $40 to $60, which is plus and minus 20% from the current stock price. That is only at one standard deviation probability, which is 68% chance. There's nothing called 100% guarantee. There's only 68% chance that the stock price will move within that range. So that is the definition of implied volatility. Now, implied volatility can make up a large part of the option premium. The higher the volatility of the stocks, like Nvidia or Tesla, the more expensive the option will be. And volatility tends to increase ahead of key events, like the earnings release, FOMC meeting, FDA announcement, right? Now, my golden rule is when implied volatility is low, it is a better time to buy options because it is cheaper. And when implied volatility is high, selling option is a better way to make money. Now, in this busy chart, I will explain why the implied volatility can play a big part of the option premium. I'm looking at the option chain for Netflix here, and I have the weekly option that expire on 28th June, on 5th July, 12th July, and 19th July. Now I'm looking at the strike price of 670 there, right, on the call option. On the 28th June, that 670 call is worth $14. Now, if I go to the same strike price, but a week later, it's worth $17. So you can say that, okay, time decay, 1 week is about $3, right? The difference between the two is the time value. Now, if I do the same thing, go to the following week, which is July 12, same strike price, 670, the option value is now 20, which is another $3, right? Makes sense, because every week it is worth $3. But in the last week there, July 19, on the same strike price, suddenly the option value jumps to 35. So it's no longer $3, it's now $15 difference versus the previous one. Why is it? Why is it in the July 19, the option value jumped $15, not $3? Well, because Netflix will release earnings before that July 19. And that makes the July 19 option much more expensive. The option that expires after the earnings always more expensive than the one that expires before that. And this is not just because of the time value, but also because the implied volatility value built into that option. So that just shows you that the implied volatility can play a big part of the option premium. Now that brings the last Greek, Vega. So Vega measures the option premium change for every $1 move in the implied volatility. For example, if the option value is at $2.50 and the Vega shows 0.2, that means if implied volatility moves from 20 to 21, which is 1% increase, right? The option value will increase by 0.2. So that means it will increase from 2.5 to 2.7. That's how the Vega works. All right, so when you trade option, right, you need to remember, option has expiry date. And because of that, option value decays every single day. So in my early years, I made mistake by buying call, buy put options most of the time. When I lost money, most of the time, because time decay hurts me every day. But the more experienced I become, the more I know that selling option is actually a better way to make money. Because when you sell option, time decay works in your favor. You are paid to wait. So I want to be a net seller of the option where I am paid to wait. So in our option mentorship program, we teach many option strategies that can cater different needs of option traders. I prefer the option strategies that have the time decay that works in my favor. Anyone can trade option and make money out of it, from a busy professional or a full-time trader or totally newbie. You can make money from trading option. We have different option strategies out there for different traders' profile, and option trading is suitable for everyone. But you need to equip yourself with the proper education, training on how option works, from the fundamentals to the trade technical, to the trade setup, to the clear entry and exit rule, and the psychology part of it. That's the whole thing that you need to learn before you trade options. Like in your life, when you learn new skills, everything is very difficult at the start. But once you learn it, you practice it. And the good thing is we have the whole support community out there with Adam, myself, and the coaches. We're in the Discord channel and help you to get on board very quick, and you will become a profitable trader very soon.
So here are some commonly asked questions about options trading. So how much capital to start? The great thing about options is that we have got over 20 different strategies that we use for different account sizes, from very small accounts to very big accounts. Bang, you have any examples?
Yeah, for example, if you have very small account, technically you can enter a trade with $200 or $300 a trade. But if you have a relatively larger account, you can expand your trade into many different strategies. So $3,000 to $5,000 actually is the ideal start.
How much time to allocate to options trading? It depends on how many strategies that you want to trade and how much you enjoy the process. But I always say that if you just want to focus on one or two main strategies, which is what I do, and to just focus on making consistent returns, then, I spend, in fact, no more than 30 minutes a day.
How much money can I make in option trading? Well, first of all, it has to be clear that there will be good years and there will be bad years. But on average, based on my past 20 years of trading, I've been getting 30 to 40% range on average. But there was time when I lost money in 2020. But there was good time also last year. I got 84%. Year to date, I have 33% as of now. So I made $1.5 million over the past 18 months.
So how do you choose the right broker for trading options? I think there are a few considerations. Number one is to choose a broker that is well established and reputable. So for example, I use interactive brokers. I use Think or Swim by Charles Schwab. But of course, there are other brokers out there. The other thing to consider is to make sure that the broker provides options that have enough liquidity, that can be filled at good prices, and enough option analytical tools to analyze your option trades, and the ability to do a lot of option combos.
How can I manage my risk when I trade options? Well, the good thing about trading options is you can predefine the risk, meaning you can determine what is your max loss in a trade. Regardless of how the market price will go, you cannot lose more than what you have intended to lose. That is a max loss. And that's the best thing about option trading. So be sure that you know how much your risk in every single trade and manage it within your risk tolerance. Somebody can be comfortable with 1 or 2%. Somebody say, I don't want to lose more than half of the percent. So it's up to you.
And the other great thing also is that using the options analytical tools, we can predefine our win rate.
Yeah.
So before we enter a trade, we can say that we want a win rate of 70%. We want a win rate of 90%. All these are predefined using mathematics from the trading software provided by the broker. So what should you consider before making your first options trade? Before you trade anything, including options, is please, you got to educate yourself first. I always say that everything in life is risky if you don't know what you're doing. Driving a car is risky if you don't know what you're doing. Swimming is risky if you don't know what you're doing. If you trade options without knowing what you're doing, it's going to be very risky. But if you know exactly what you're doing, trading options no longer becomes risky. It becomes very, very lucrative. And the great thing about trading is that before you trade with real money, you can trade with paper money, a demo account. And we teach our students to trade with demo account paper money, and only when you can make money consistently with the demo account, then you use the real money. It's kind of like a pilot. Before you allow the pilot to fly a plane with real-life passengers, they go into the simulator and they take off and land many times until they can do it safely and consistently. So another common question people ask is it better to trade stocks or trade options? Well, the great thing is when you think a stock price is going up and you buy a stock, then you only make money if the price goes up. You don't make money if the price goes sideways or goes down. The great thing about options trading is that it's more flexible. It's like a Swiss Army knife, where you can construct an option strategy where it increases your profit zone. You don't need the price to go up to make money. In many of our strategies, the stock price can go sideways, the stock price can even go down slightly, and we are still very, very profitable. So it increases your win rate and your profit zone. So before I start trading, I'm very clear about my trading plan. So that means that before I enter a trade, it's not randomly or based on a feeling or based on something I read in the newspapers. I always have a trading plan where before I enter a trade, it must meet all my entry rules. So only when all the entry criteria are met, I know it's a high probability trade, and I know what is the risk per trade, I then enter the trade. And similarly, I also have my exit rules in my trading plan. So once my exit rule is hit, I exit the trade at a profit or at a loss at times. And I know that there will be winning trades, but there'll also be losing trades. But the important thing is that when you follow the right trading plan and the right trading strategies, your wins will more than offset your losses. And you always end up with a net profit at the end of your trading journey.
One way to increase your probability of winning is to be a net option seller. This is based on my costly mistake that I made in the early years of my trading, where I was just the buyer, where I lost money most of the time. In the program, we will explain why is it option seller have a higher probability of winning. In trading, losing trades are inevitable. Sometimes it's a losing streak, and that is normal in trading. Don't give up. It is important for you to be persevere and stay in the game so that when the winning streak comes, you are there to reap the benefit. So I have experienced setbacks many times in my trading career, but I have always come back much stronger and win big time after that.
So here are some tips for trading options for complete beginners. One of the things that I can share is that over the last 30 years, I've traded almost everything under the sun. I traded stocks, I traded CFDs, I traded Forex, I traded futures, I traded options. And after trading everything, I can tell you that today, over 90% of what I trade are options. Why? Because I found that out of all the instruments, options has given me the most consistent results, the most consistent profitability. Because, like mentioned before, with options, I'm able to construct trades that do well under different market scenarios. So I don't need the market to go up to make money. I don't need the market to go down a lot to make money. I can have the market go sideways and do very well as well. I've got a very wide profit zone. I can predefine my win rate and predefine my risk very clearly as well. So that's why it's something which I highly recommend people learn. So if you want to be serious about investing or serious about trading in the markets, then options are a tool that you can use to complement and to turbocharge your investment and your short-term trading returns.
And one more thing about trading options versus trading stocks. Trading stocks, even if you set a very clear stop loss for your trade, but if the stock price gaps down a lot, you could lose many times bigger than the loss you intend to lose. Not the case for option trading. When you enter an option trade, you predefine your max loss, and you cannot lose more than that.
So remember that in options trading, you can choose to focus on buying options, or you can choose to focus on selling options. And I think one of the most common things I notice is that many beginners and amateurs, they focus on buying options because it looks more lucrative, that, oh, I can have unlimited reward and I just have to pay a small premium. But in reality, I think what both Bang and I have discovered in our options trading journey is that when you buy call options or buy put options, once in a while you can make a lot of money. But in the long run, you don't make as much money. Or in fact, you may even lose money because it's like buying a lottery ticket. And one of the things that we realize is that professional option traders, they tend to focus on selling options more than buying options, because selling options have a much higher probability of winning. But it's a way of doing it where it limits your risk. Because if you sell options naked, it's unlimited risk. You should never do that. But when you learn to sell options in a way that you hedge your portfolio with the right combination, then option selling can actually be done safely in a very lucrative, consistent way. And in fact, that's what both of us have in common.
Now, with this beginner's guide, we hope that it provided you with a much better foundational understanding about options. Do feel free to leave comment below if you have any questions that you need answered.
So for someone completely new to options, I know that you are really excited about the next step, how to make money from options trading. Now, this video is a great starting point. But for those of you who want to bring your options game to the next level and to trade profitably and consistently, Piranha Profit offers various membership options tailored to suit your needs, from beginners to advanced strategy lessons, in-house community Discord support, live webinars, monthly newsletters, and even trade action notifications. We are sure there's something that will fit your needs. So for more information, head over to the link in the description below, and we will see you on the other side.
Till next time, keep winning.